Let's bring in our first guest for the hour. We've got Beth Ann Bovino, S&P Global Ratings Chief U.S. Economist. Beth Ann, it's good to talk to you today. There was a lot of concern going into today about the impact of the Omicron wave in this particular jobs report. How did we see that reflected?
Only in one place, and I would say that came from the hours worked, which you saw come down a little bit, I think to 34.5 hours rather than 34.7. But that's largely because people had absenteeism. People had to stay home and take care of themselves from the virus or their children. And that seems to be just a short intermission rather than anything strong. The jobs numbers, as you mentioned, were incredibly strong. And particularly, there were upward revisions that were over twice what they had previously reported. That to me says a very strong reading going forward, and it certainly gives the Fed reason to keep moving on with their tightening schedule.
Hey, it's Brian here. I want to get into the nuances of the differences between the household survey and then the establishment survey, because it's the establishment survey interviewing employers themselves that got us that nearly 500,000 payroll gains number on the top line there. But the household survey showed that there were still 6.5 million people that said they were unemployed because of disruptions related to the virus, which is a sharp uptick from the 3.1 million figure that we had seen in December. So how do you kind of square those things from one another?
Well, I think that there's a couple of factors. There's temporary people who are temporarily unemployed, meaning that they are on furlough tied to the time to Omicron. That could be one factor. Another could be that people had just left the workforce. They quit, but they would still be considered unemployed, not necessarily left their basically quit their jobs and are unemployed. So there's a couple of factors that are at play here, and I think a big factor there, the big reason is because of Omicron. People taking a break. People concerned about the virus still.
Beth Ann, Brian set this up for us in terms of what this could mean for the Fed. Certainly going to be a lot of speculation over the next several weeks about whether, in fact, the Fed's likely to move more aggressively. You know, how does today's jobs report factor into all that?
Well, when you're looking at the unemployment rate that ticked up to 4%, that was because both people got jobs, if you look at the employment figures, as well as people entering the workforce. I think those are concerns that the Fed had. That's also a check off the box for them. Those job numbers that we saw January and also upward revisions the prior months also give the Fed reason to move. So I think this just says, I mean, if the Fed was singing a song, it would be ain't no stopping us now. They're on the move. And we think they're going to raise rates likely 6 times this year. You talked about a 50-point rate hike. It seems it's unlikely in my mind that they would move for one in March, although certainly a 50-point rate hike is on the table for this year.
I'm sure the Federal Reserve officials are all singing that song. I want to ask you about the seasonal factors here, because that was a big reason for the dramatic revisions that we had seen to all the months in 2021. How much water should we hold then in the number that we had gotten in January, knowing that there could be as much of a dramatic revision of 400,000 upward, or in some cases 400,000 downwards, as we saw for some months based off of the yearly benchmark changes?
Well, you could, revisions are certainly nothing that we can ignore. They happened all the time. Although the biggest revisions we usually see for the payroll numbers are in August, because that's often because businesses haven't actually put in their forms. So that'd be one factor to play in mind. I think we can expect to see certain revisions, as you mentioned, because of the adjustments done by the BLS at this time in January. But still, regardless of whether it's going up or down, these are strong numbers, and it is a positive sign going forward.
And just as a quick follow-up, I mean, wage pressures, kind of 5.7% on a year-over-year basis. Does that signal anything to you, concerns about a wage price spiral?
There is concern about these wage pressures, and I'd also add that those wages they have been. I don't know what the most recent numbers are today, but they have been in real terms in negative territory. So we see it that nobody's happy. You've got people getting fatter paychecks, but they're not able to spend as much on at the supermarket to get what they need. So it's a real struggle. That goes into the question of wage spiral for the Fed that the Fed would have to address. I don't think we're quite there yet in terms of what we saw in the 70s and 80s, because a lot of things structurally are different. We don't see, in terms of contracts, we don't see businesses having automatic inflation adjustments in wages at this point in time, not nearly as much as we had back then. But still, the risk is there, and I'm sure the Fed is taking good note of that, particularly when we see inflation expectations climbing higher.
Beth Ann Bovino, S&P Global Ratings Chief U.S. Economist. Good to have you on today. Happy Friday.